The stock market has experienced numerous crashes throughout its history, with the most recent one being the 2020 COVID-19 crash, which saw the S&P 500 index plummet by 34% in just 23 trading days. The 1929 Wall Street crash, also known as the Great Crash, is still considered one of the worst financial disasters in history, with stock prices falling by 47% in a single year. In fact, according to a study by the Federal Reserve, the average stock market crash results in a loss of 35% of the market's value. With the current market capitalization of the S&P 500 index standing at over $28 trillion, a crash of this magnitude could result in a loss of nearly $10 trillion. Here's why that matters. The stock market is a complex system where companies raise capital by issuing shares of stock to the public, and investors buy and sell these shares in hopes of earning a profit. The market is made up of various exchanges, such as the New York Stock Exchange and the Nasdaq, where stocks are traded. The S&P 500 index, which is widely considered a benchmark for the overall health of the stock market, is composed of the 500 largest publicly traded companies in the U.S. The market is also subject to various factors, including economic indicators, such as GDP growth and inflation rates, as well as geopolitical events, like wars and natural disasters. For example, the 1973 oil embargo, which led to a 45% decline in the S&P 500 index, and the 2008 global financial crisis, which saw the index fall by 38%. A stock market crash occurs when there is a sudden and significant decline in stock prices, resulting in a loss of wealth for investors. This can be triggered by a variety of factors, including a decline in corporate earnings, a rise in interest rates, or a geopolitical event. The crash of 1929, for example, was triggered by a combination of factors, including overproduction, underconsumption, and a decline in agricultural prices. The crash of 2008, on the other hand, was caused by a housing market bubble bursting, leading to a credit crisis and a subsequent decline in stock prices. According to a study by the International Monetary Fund, the average stock market crash is preceded by a period of rapid credit growth and a rise in asset prices. For instance, in the years leading up to the 2008 crash, the U.S. housing market experienced a significant bubble, with housing prices rising by over 100% between 2000 and 2006. One of the key factors that contributes to a stock market crash is speculation and herd behavior. When investors become overly optimistic about the market, they begin to speculate, buying up stocks in hopes of making a quick profit. This creates a self-reinforcing cycle, where rising prices attract more investors, who in turn drive prices even higher. However, when the market begins to decline, this cycle reverses, and investors quickly become pessimistic, selling their stocks and driving prices even lower. According to a study by the Journal of Financial Economics, herding behavior is more pronounced during periods of market stress, with investors tending to follow the crowd and sell their stocks during a downturn. For example, during the 2020 COVID-19 crash, the S&P 500 index experienced a record number of daily declines, with the index falling by over 10% on several occasions. The stock market is closely tied to the overall economy, and a crash can have significant consequences for businesses, individuals, and governments. A crash can lead to a decline in consumer spending, a rise in unemployment, and a decrease in economic output. For example, the 2008 crash led to a global recession, with the U.S. economy contracting by 5.1% in 2009. The crash also led to a significant increase in government debt, with the U.S. federal debt rising from 39% of GDP in 2008 to 79% of GDP in 2019. According to a study by the World Bank, the average recession caused by a stock market crash lasts for 18 months and results in a 5% decline in economic output. The 2008 global financial crisis is a prime example of how a stock market crash can have far-reaching consequences. The crisis was triggered by a housing market bubble bursting, leading to a credit crisis and a subsequent decline in stock prices. The crisis resulted in a global recession, with the U.S. economy contracting by 5.1% in 2009. The crisis also led to a significant increase in government debt, with the U.S. federal debt rising from 39% of GDP in 2008 to 79% of GDP in 2019. According to a study by the Federal Reserve, the crisis resulted in a loss of over 8 million jobs in the U.S., with the unemployment rate rising from 5% in 2007 to 10% in 2009. Some argue that central banks, such as the Federal Reserve, play a crucial role in mitigating the effects of a stock market crash. By cutting interest rates and implementing quantitative easing, central banks can help to stabilize the market and prevent a complete collapse. For example, during the 2008 crisis, the Federal Reserve cut interest rates to near zero and implemented a series of quantitative easing programs, which helped to stabilize the market and prevent a complete collapse. According to a study by the Bank for International Settlements, the use of unconventional monetary policies, such as quantitative easing, can help to reduce the severity of a stock market crash. In conclusion, a stock market crash is a complex phenomenon that can have significant consequences for the economy and individuals. By understanding the mechanisms that contribute to a crash, including speculation and herd behavior, we can better prepare for and respond to these events. As we move forward, it is essential to consider the role of central banks and other regulatory bodies in mitigating the effects of a crash. Subscribe for more deep dives.